Good day, my name is Adrian Meager and I'm the Chief Investment Officer of Orion Investment Managers. Welcome to our Q2 2026 asset allocation update, focusing on our multi-asset funds. This has been an extraordinary quarter. On the 28th of February, the United States and Israel launched coordinated strikes against Iran under Operation Epic Fury, targeting the country's nuclear and military infrastructure. Iran retaliated within hours, striking energy infrastructure and military installations across all 6 Gulf Cooperation Council nations. Straits of Hormuz, through which 1/5 of global oil flows, saw tanker traffic collapse by 70%, and by 27 March, Iran formally declared the straits closed to allied shipping. Brent crude surged past $126 per barrel before settling in $98, following a Pakistani brokered ceasefire on 8th of April after 39 days of hostilities. The ceasefire remained fragile, the strait has not fully reopened, and negotiations continue. The energy shock has driven inflation sharply higher and forced central banks globally to pivot from easing to holding or actively considering rate hikes. Let's look now at domestic asset classes. We'll start with cash, and this is South African cash. The South African Reserve Bank has ended its easing cycle, and we anticipate 2 25 basis point rate hikes before year end, driven largely by the Iran war fuel shock that pushed headline CPI to 4% in April, which has tested the upper edge of the SARB's tolerance band around its new 3% inflation target. Against this backdrop, we maintain a cautious view on cash, which we still feel is unlikely to exceed our return threshold of CPI plus 3 in our stable funds and CPI plus 4 in our balanced mandates. Next, we move to South African bonds. We retain a constructive stance on nominal bonds. The generic 10-year yield sits at approximately 8.55%, which is down 185 points year on year, with valuations remaining relatively attractive in both historical and relative terms, despite the elevated uncertainty created by the Straits of Hormuz disruption and its potential second-round effects on domestic inflation. We maintain zero exposure to inflation-linked bonds within our multi-asset portfolios, where current break-evens do not adequately compensate for duration risk. Let's look at property now. Following the South African property index's strong 24% rally over the past year, we maintain a neutral exposure at 2.75 in stable and 5% in our balanced mandate. While property fundamentals remain supportive, the prospect of renewed SARB rate hikes tempers near-term valuation appeals. South African equity. We remain neutral on domestic equities, maintaining our overweight in industrials, having reduced some exposure to resources, and remaining underweight financials relative to the FTSE JSE Capped All Share Index. Our overweight in industrials reflect the sector's relative resilience during March's geopolitical sell-off, with earnings expected to grow approximately 9% per annum and valuations remaining reasonable at a forward P of around 10.7 times. We have reduced resources exposure despite the sector's strong 12-month performance. The mining index fell 24% over the past 3 months as the initial commodity price surge gave way to demand uncertainty and significant profit-taking. Our underweight in financials reflects the sector's sensitivity to renewed SARB rate hikes, with higher borrowing costs expected to weigh on credit growth and compress lending margins in the near term. Let's now move to the global asset classes. As per usual, we start with global cash. We remain underweight global cash. The era of monetary accommodation is ending across developed markets. The US Federal Reserve held rates at 3.5 to 3.75, with FOMC officials signaling that hikes may follow should oil-driven inflation persist. Moving now to global bonds. We hold a neutral stance on global bonds, with US headline CPI at 3.8%. Markets increasingly acknowledge the possibility that the Fed may need to raise rates this year. We have shifted exposure from shorter-dated TIPS and high-yield corporates into international treasuries and maintain a shorter duration bias relative to the Bloomberg Global Aggregate Index. Let's now look at global equities. We remain positive outlook on global equities, with our exposure at roughly 34% in balanced mandates and about 15.5% in our stable mandates. We favor the United States, which represents roughly 72% of the MSCI World Index, reflecting our conviction in the earnings resilience and innovation leadership of US corporates, particularly within the technology and healthcare sectors. Notably, US equities have shown to be significantly more resilient than developing markets during March Iran-driven sell-off. So in summary, the Iran war and the closure of the Straits of Hormuz have fundamentally reshaped the macro landscape this quarter. Against this backdrop, we maintain conviction in nominal bonds and developed market equities, remain cautious on cash with zero exposure to inflation-linked bonds, and favor the United States from a geographic perspective. Portfolios are positioned for moderate growth emphasizing diversification, valuation discipline, and real return potential. Asset allocation remains our primary driver of portfolio performance. This quarter, the geographical overlay from the Iran conflict has been a critical input across all asset classes. We remain anchored in valuation awareness and risk diversification and consistent execution, and will continue to manage clients' portfolios in accordance with these principles. Thank you, and if you enjoyed today's YouTube presentation, please like and share, and we look forward to chatting to you again. Have a nice day.